Banking stocks have been in focus over the past several days, especially the large cap private banks. Market watchers now seem to be getting concerned over high valuations for some of these as they have hit new record highs. Do fundamentals justify the current rally, and is there enough potential for these banks to deliver above average returns going forward? Let's put some of these questions to Mr. Paresh Sukthankar, Executive Director of one of India's largest private banks, HDFC Bank. Paresh, thank you so very much for joining us on Market Sense. First off, we have seen in the last quarter that corporate loans have grown faster than retail loans for your bank. Now that 3G is out of the way, where are we likely to see most of the loan growth coming from?
Well, if you look at the first quarter growth that we saw, first of all, the overall loan growth across both corporate and retail had picked up reasonably well, and the overall loan growth therefore was a little ahead of the system. It was between the two, on a relative basis, corporate did grow faster than retail, and there was an element which was one-off relating to the 3G which you just referred to. But even adjusting for that 3G piece, the core corporate loan growth was in the almost a 30% range, which was essentially working capital, some other term loans, that is X3G, and that has been our traditional growth area. So what we will continue to see way past this one-off which was 3G or MAX related would be essentially the working capital and medium-term loan pieces.
Right, let's focus a little bit on interest rates, and now at HDFC Bank you've already raised deposits, you've raised deposit rates. What about on the lending front?
I think what I said about the system would hold true to a large extent for us, in as much as we do expect that lending rates will keep, will sort of rise to allow us to maintain margins. As far as actual increases, so far we have seen an odd retail loan product which has seen some increase in rates. On the corporate side, certainly the short-term lending rates have moved up just a little. Again, this is reflective of the liquidity in the system more than anything else. And at the longer end, as we've seen in the last few days with the 10-year bond yield moving up to over 8%, it's now almost 8.07 or thereabouts. There is every reason to believe that you might have some upward bias in term lending rates as well, although I guess it hasn't yet happened.
Mm-hmm. So in which loan segments have you raised loan rates, or you're intending to raise rates, and where are we likely to see more rate increases going forward?
Car loans has seen, I think a small increase, 25 basis points or thereabouts. Some of the other products, again, it depends on which segments, but there have been increases of around 25 basis points. It's not across the board, and I think the general bias seems to be that you will see an upward movement. It could be in more than one sort of tranche in a sense. And again, it's not that we have necessarily seen the last of the deposit rate increases either. So depending on how rates move over the next few months, you would see perhaps further increases in lending rates as well.
So give us a sense of the kind of cumulative rate hikes that we are likely to see this year then.
I think from here, perhaps between now and the end of the year, you could see another 25 to 50 basis points increase. Remember, I think, as you've had further information flowing through, also, whatever has been coming out from the regulator, I guess the noise about concerns on inflation have been only getting louder. Even the rate at which the expectation now for inflation to touch by March has been a little higher than what it was earlier. So clearly, and that I think has, the bond markets have certainly reacted to that information flow. So it is logical that therefore, lending rates, obviously deposit rates perhaps leading the way, but deposit and lending rates should also move up somewhere in that 25 to 50 basis points. Having said that, the bond yields have already reacted, so I don't expect them to go up by more than maybe 20-25 basis points from where they are today. But those rates which have not yet moved, which is really the deposit rates and lending rates, have a little more of a catch up to do.